welcome to another episode of Loose Change. I'm back with Steffan and Jacob.
We back, baby.
Okay. Anyways, Muhammad is in Mexico, so he actually cannot be here.
Which city?
He's in Mexico City.
Ooh.
Wow.
Yeah, I don't know where that is, but anyways, how's everyone's week? What was your? We haven't seen you in a while.
I think it's in Mexico, bro.
Mexico City.
Yeah,
I don't think Mexico City is a thing.
it is. Okay, but I've
Anyways.
been.
I haven't seen you in a while. How have you been?
I mean, I've been alright, bro. I literally haven't changed from the last. I've been wearing.
Okay, shut up. I'm gonna. What's it called? Okay, we're gonna move on then. Steph, do you want to talk about your week?
My week has been amazing as always. Right. I think this week has been really productive for us on the real estate front. Putting in a lot of offers this week, especially since it's reading week. So I actually have this week off, but instead of relaxing, I'm working.
So you're on.
I am on.
Yeah.
That's
okay,
it.
perfect,
That's
nice.
it.
Okay, so today.
How was your week?
My week was whatever. I don't know. It wasn't that big of a like. It was normal. I had a task to do at work today, and I finished it.
Wow.
in
Okay,
an hour.
guys. That ends the podcast. We
What's
can
it
move
called?
on.
Okay, so today's topic is going to be a little bit, I guess, practical. Hopefully for people,
Yes.
a little bit more understanding. It's something that people know in general, but
People know, but also don't know.
also don't know.
Yeah.
That's a good
Yeah,
point.
I feel like we're gonna talk about a mystery here, so it's something that like everyone hears about, but hopefully.
So we're talking about investing.
By the way,
Yes.
before we move on,
Oh, you ruined it.
Can we just appreciate how we have mics of our own now?
Why?
Yeah.
Do you not have mics of our own?
No, remember last time we were sharing?
Oh yeah, facts. No, I don't think that podcast made it out.
Oh, guys.
Yeah, it did.
Did it?
It's all good. It's all good.
Did we come?
Well, hey, we are overcoming technical
Did- did-
difficulties every
sure?
single
Yeah,
day
it's
here
less
at
than it's
Capstone.
supposed
Honestly, man, we've had. Sorry. By the way, we've had so many issues. Like in general, like we've super inconsistent. But like we're trying. I swear we're trying.
We're doing our
We've been
best.
consistent every 2 weeks at this point.
Even though we're supposed to be doing it every week. But I mean, like we're trying. We just had a lot of issues. So anyone who subscribed to us and has their notifications on,
We're so sorry.
Honestly, you guys should be listening to Apple Podcasts and Spotify.
So I think we should plug a little bit in the beginning.
Yeah.
So we're on Apple. In case for people who don't want to listen to the end, so we're on Apple Podcast.
all
We're
you
on
rich folks.
Spotify, also.
For all those medium folks,
So for anyone who doesn't want to sit and watch us,
and eventually we'll be on SoundCloud for all you broke folks.
Are we?
and I don't think we are. Anyways,
We should.
So yeah, we're on Apple, we're on Spotify, and we're on YouTube, obviously. For
and we're on
anyone-
everything else if there's Google, whatever it may be.
Yeah. So if you don't want to sit and watch us, if you're on your way to work, on your way to school, whatever,
You can just listen to our
yeah,
soft
just
stuff.
listen
voices.
to us. It won't be as nice, I guess, because of our faces. But, anyways, and also, I said we'd say this at the end of every episode, but I think we'll start off. If you wanna learn more from us, if you wanna work with us in any
Yeah.
shape or form,
Buy
Joint
our course.
venture.
no,
And-
we don't have a
oh,
course.
yeah.
Just message us on Capstone, or if you know any of us personally, just message us on our personal Instagrams. It doesn't
Yeah.
matter.
We are always open to talk anything real
Yeah.
estate investing. Just hit us up.
Relationships, everything.
Anything. We're counselors. So, anyways, thank you for coming back and watching us. So yeah, today we said we're gonna kind of talk about investing, and not just real estate investing. We're gonna kind of do like high level, kind of just in general talk about
Investments.
just a bunch of different options, a bunch of different investments you can do. I'm not too knowledgeable about this topic.
Options is a type of investment.
But hey, we are gonna dive right into it. So number one,
go.
what is an investment and how is it different from
You have to do it.
from savings?
What is it, Stefan? Explain to us.
So
No, actually, I think that's actually good.
Okay.
No, as opposed to savings, like investing versus savings.
yeah,
I think that's a good way to start.
Can I answer this one?
Sure.
All right. So this is how I kind of think about it, right?
Mm-hmm.
So you're a farmer, and you're trying to have a field of corn, right?
Cool.
Right. So you're collecting all your seeds. At this point, you're saving. You're collecting all these seeds where you save them in your back pocket to grow them later.
Mm-hmm.
But then someone burns down the land and the soil is not fertile enough, and now you have no land. And now you only have savings in your back pocket.
Your seeds.
Yeah.
Okay.
So you move to another piece of land that's fertile and has nice soil. You drop the seeds on. They grow. That's what investing is. So To invest, you need to save before. That's how I think of it.
You need to save to invest, is what you're saying.
What the
You need to save. You need to have something. You need to have something. You need to put in. You need an input
Yeah.
to get an output, isn't
Yeah.
it? Is that not true?
Yeah.
So the
yeah.
input is the seeds, and the output is the corn.
But I don't get what the burning of the first field has to do with it.
Anyways,
I added that for,
Okay,
like,
okay. So
entertainment
so
purposes.
my kind of take on investing. Let's actually just bring it back to practicality. So like money, So I see investing as you go to work, you take a hard-earned dollar, and instead of spending that dollar, you choose to actually keep it, right? So it does involve
just say
saving,
that?
okay, right? And then instead of just keeping it, you also decide to throw it back into something, whether that's a venture, whether that is a product, whether that is a business idea, whatever it may be, and that something comes back and brings you more dollars than the dollars you put in.
Well, you expect it to bring you more dollars.
Yes,
Yeah.
you expect it to bring you more. Yeah, because there are good and bad investments, which we will talk about hopefully in this
Because
podcast.
savings, people don't realize that you saving, like obviously you need savings. Like you need to have
Yeah.
a certain amount where
Yeah.
if something goes wrong,
like an
you
emergency fund kind of
but people don't realize like if you have a lot of money in your savings, you're losing money. Like you're literally losing money every day.
As in, if you think about it, like cash itself has no value unless it's moving. Think about it. If I actually went and withdrew, like, let's say I had $100,000 in the bank account and came here with like a bag of cash worth $100,000. You might be like, oh yeah, damn, Steffan, you rich. You got $100,000. You go like withdraw. You can take that out in cash. But then in just doing that, in placing it there, I am losing money because time moves on, and we'll talk about the time value of money. But that cash does not do nothing unless I go and use that $100,000 to buy something that is going to bring me money.
Like cash depreciates basically.
Exactly. Cash is worthless if it is not actually doing something.
It's a depreciating asset.
Yeah, it is a depreciation.
So
like your
is
car.
cash really king?
And why is
Like
that?
everyone's-
and
like
why
everyone's
is
car.
cash a depreciating asset? Can you guys explain that? Because some people don't understand.
Because of inflation.
Hey.
So for anyone who doesn't know what inflation is,
Whoa, inflation. Tell us.
inflation basically, so every year the world becomes more expensive.
Yeah.
No matter what.
The rich keep on getting richer.
Materials get more expensive. Houses get more expensive.
Yeah.
Products get more expensive. Minimum wage goes up. So everything becomes more expensive.
Expenses go up in general.
Exactly. So if you have $1, so for example, if you had $100 50 years ago, realistically, and you bring it today, yeah, you're still gonna have that $100.
Physically,
But you're gonna have that 100 physical dollars, but realistically, you lost money throughout that 50 years because now
Exactly.
everything is so much more expensive that what you could have gotten 50 years ago for $100
Yeah.
will not get you the same thing.
For example,
Perfect.
like $100 could have bought you 100 cups of coffee, while $100 today
Yeah.
can only buy you like 90
cup
something.
of
And like
coffee.
in terms of real world examples, so Canada, for example, the inflation rate in Canada is 2.1%.
Yes,
So
sir.
that means every year on average, prices and the cost of goods and services go up on average around 2.1% a year.
What?
So for example, if you had $100 on January 1st, let's say January 1st of this year, 2020, right? At the end of December 31st, December 2020, the cost of living in general has actually gone up to $102.10. That means if you kept that $100 and didn't do anything with it, you have just lost $2.10 because now your $100 is worth a little bit less.
Wait, I have a question. So we just contradicted ourselves. We said we need some savings for an emergency fund, but then
But that's different. though.
it's a depreciating asset. So what? Okay, say we do have an emergency fund of $10,000.
The reason that's different, an
For-
emergency fund, because the thing is, like,
An emergency fund, yeah.
Some investments are hard to come out of, right?
Yes.
Not every
They're
investment.
not liquid.
They're not extremely liquid. Yes, they're not as liquid as cash.
Yeah.
So if you need surgery right away,
It's like, do you go into your GIC?
do you want to
and-
wait like 3-4
like,
business days to pull out your money, or
Yeah,
do
Do you
you
want to
need it
do you
right
want to
away?
wait a couple of months to sell your house?
No,
No,
Right?
exactly.
Right? So that's why, like, even though
Yeah.
obviously you don't want to, like you don't want to save a lot. You don't want to have like 100 grand just sitting in your bank account, 50 grand just sitting in your bank account doing nothing.
Well, depending on
your age,
Yeah. Well,
right,
not
yeah.
even that. Depending on like how your net worth.
Oh
at
yeah,
that
yeah,
point.
yeah. If you're a billionaire, obviously it doesn't matter. I mean,
Some
like-
people hold like 100K. In
No,
there,
but a lot of, but I know a lot of people who have like 50, 60K in their bank account, and their net worth is 50, 60K. Like,
Really?
Yeah, like
Wow.
because they don't know what to do. They don't know what they should they buy a house? Should they invest it somewhere? Should they put it in a savings account? And the thing is, actually no, I'm not going to talk about it.
Talk about it.
No, we'll get fired. We can't talk about it.
Okay.
Were you about to give an example?
I was going to bring up like savings account. I can't do that.
But I can because I don't work there.
Yeah.
I mean, I guess.
But
That's a good point.
I don't know what to say about it.
So,
I
like,
don't know what you were gonna say. About
we were talking about inflation, how the cost of things goes up on average. So in Canada, on average, things go up by 2.1% a year, which means that it's getting a little bit more expensive. So that means if bread was $100 at the beginning of the year, at the end of the year, it's worth $102.10, right? That means if your money has not earned that 2.1% at least, you have lost money. You can no longer afford food or that bread or that product that you wanted.
I don't think I can afford that bread in the first place.
And so $100 bread, bro, Ezekiel bread. Anyways, right? So inflation is like one thing that, kind of makes us learn about what is investing, because if things go up every single year and things are getting more expensive, then we need our money to at least keep up with inflation for it to be worth something, right? And then on top of that, like
that's bare minimum.
Bare minimum, of course. But then if outside of inflation, we also need to like make a return on that. So what is a return? How would you define,
ROI?
I think
a
Basil has
return
an
on
answer for that one.
ROI, so return on investment for people who don't know, very self-explanatory. It's literally just the return that you make on your investment. If you invest $100,000 into private lending and you make $20,000. You make $20,000 at the end of a 1 year term. You just made 20%. Your ROI is 20%.
So Basil, actually, the true story. Steffan told me about this website called Lending Loop. And
are we sponsored by them?
No.
Okay, then don't talk about that.
Actually, we're like, what's the opposite of sponsored? Like, I hate this place. I hate them.
Okay. Yeah, talk about them.
Steffan was like, hey, you should invest in some companies in here. They're just starters. They were what are they? Whatever they are.
So
they're shitty companies in general.
Yeah, basically.
And they're what would you call it? They're
penny
rated.
stocks?
No. It's not even stocks. It's like you invest in a company. You literally.
Okay, yeah.
So I put in
you invest in a company through debt by lending them your own personal money.
Yeah. So I didn't really like trust it too much. So I put like a couple dollars, like $300.
Couple dollars.
Yeah.
Couple bucks.
So I put $300, and do you know what I get back?
You lost $200.
No. I got $62 back.
How long?
$62 back.
2 years.
Over
2 years. Oh, shit, eh? That's crazy.
Facts. Yeah. No. Same. I think I put like $250 in. I got back $42.
That's crazy.
So yeah. So let's talk about what is a bad investment versus a good investment, right?
That's clearly a bad one.
Yeah, because that's clearly a bad investment, right? So I would classify a good investment as it needs to contain three key things. I would say.
Oh, this is on our
binder.
On our binder, yeah.
So number one, security. The investment needs to be secure. Number two, it needs to give you some sort of cash flow. Number three, you need compounding. So any good investment needs to have a perfect balance between all three.
Security, cash flow, and compounding.
Security, cash flow, and compounding.
But not all investments have that. All those three.
So not all investors have all
exactly.
those.
So exactly. So let's dive into it. So give me an example of an investment that you would say is very, very secure, but might not have as much cash flow or compounding.
Do you want to talk? Okay,
bonds.
so how about
government bonds?
Okay, so how about we talk about the type of investments first, and then we'll kind of do that. We'll rank like them because now that we know you need security, compound, and cash flow.
Yeah.
So what are the types of investments?
Tell me, Basil.
So off the top of my head, obviously real estate is investment. There's bonds. So government bonds are basically, correct me if I'm wrong, it's basically you buy a certain you give the government basically a certain amount of money and they give you a certain return at the end of it.
I'll kind of correct you. They so the government needs money to pay off their debts. So they issue a bond, and the bond is basically you buy this certificate that says the
they will
government
pay you back at a later date.
Yeah,
someone's getting an IOU from from the government.
Okay,
right. So if like you're investing in bonds, you're investing in
the
debt.
Government, essentially, in the debt of the government. Okay,
which is very safe because typically governments don't get overthrown or like toppled
So
or
So we said real estate, bonds, mutual funds.
Stocks.
stocks, which are also like
so stocks and the mutual funds. A lot of people don't really understand what a mutual
The
fund
difference
is.
between a stock
well,
and a mutual fund.
explain a stock before you go to mutual
Okay,
funds.
so a
'cause you're
stock.
it's also like a corporate bond.
Yeah,
Kind of.
it's very very
Is it?
popular nowadays. Like everyone kind of knows what a stock is. It's like you literally you are investing in a company.
Stock's not a corporate bond.
What is a corporate bond?
Okay, go on.
Anyways, a stock. So stock, you literally are investing in buying shares of a company, and then so you're buying shares through either a bank or through some sort of like financial website or something like that. You're buying shares into a company at a certain price. Now, obviously, depending on how the company does, depending on their balance sheets, all that stuff, it can go up and down. Now,
Depending on like fundamentals,
Yeah,
depending
depending
but
on-
it can also be affected by news, right? Like
yes,
the good news,
like,
bad
yeah,
news.
literally this most simple thing, like something can happen and it'll go down. For example, Nike, when Zion literally ripped his shoe, the most simple thing, it crashed Nike, and then 2 days later went back up to normal.
Yeah.
Same thing with Boeing. Like when Boeing went down, like when the airplane crashed, it went down like $100, but then it just went back up a couple weeks after.
Wait,
So
the
anyways,
plane went back up a couple weeks after.
yeah, the plane did.
Oh.
So you're buying shares into a company at a certain price, depending on a lot of environmental and financial things that happen with the company. The price of the stock can either go up or it can go down, and that kind of determines your rate of return, I guess, on the stock.
Okay.
So then that's number 3. Number 4, mutual funds. You can explain mutual funds because you know it more than I do.
Yeah. So mutual fund, typically you need someone who has a mutual fund license to be able to purchase the mutual fund on your behalf. So what a mutual fund is, it is a safer way to invest in that you're investing in a diversified pool of stocks. So it's like, for example, you might have a mutual fund that contains all the stocks of like the top 5 banks in Canada, and that might be pulled together and considered one mutual fund.
Okay,
right?
boss. Then what's that? What's the difference between that and an index?
So
Investing in index.
investing an index typically is a tracker for a market,
All right.
whereas a mutual fund actually contains those individual stocks pulled together. An index fund tracks, for example, so you can have an S&P 500 index. It actually tracks the returns of the index.
This
so
is
it's almost like
getting a
investing
little
in
bit technical. Like I guess for the
Yeah.
people who actually like know stocks, so like kind of understand this, I'll try and do my best to explain it to
Also,
everyone else.
Yeah, give me one second. Yeah. Keep
Anyways,
talking.
so like that's what an ETF is,
Yeah,
right? So
yeah.
so mutual funds are very similar to ETFs. An ETF, again, this is very high level, is basically where you take a pool of companies, for example, the top 50 technology companies in the world. You put them all in a pool and you invest
Yeah.
in them. Obviously, how those companies all do is how
Yeah,
the
It's
ETF does.
it's obviously safer because there's
It is,
it's
yeah,
more
'cause
diversified
exactly.
rather than
now,
one company.
a
right?
mutual fund is you getting someone to do that for you, and you pay fees
So a mutual fund is just you being lazy, essentially.
to a certain extent, and I would feel like it's a little bit more safe than
It is,
what's
yeah.
it called?
So yes, because like it's so investing in a fund is always more safer on average than investing in a stock because a fund is a pool of stocks, whereas in a stock is just a single company. Like for example, it's like when they say never put your eggs in one basket.
Yeah.
That's what diversification is. So for example, if you maybe were in Enron like in the 2000s, you're killing it, but then fast forward to what happened to Enron, you would have lost all your money. Had you maybe been in like Enron or Enbridge or like other energy companies, for example, if Enron went down, Enbridge might still be up. So you kind of diversify by putting your money in a basket of stocks, and that's what a fund is.
Yeah. And okay, fair.
So a mutual fund. A mutual fund can also, knowing this at the bank, obviously we're going to keep high level because we're not really licensed, but it can bring you anywhere from 3% to 9%.
In terms of returns.
In terms of return,
typically.
right? So that's your average rate of return. What we learned at the
Yeah.
bank is that the average rate of return for a mutual fund is 3 to 9%. Obviously, a stock, you can't really measure it because it's literally just dependent on what stock you invest in and how that company does. Very difficult.
Yeah, it can range from
It can
0.3%
to literally 1,000%. It can
yeah.
literally, yeah. Now, I guess the last one I'll bring up is a one that I guess most people have, just a savings account.
Yeah.
So
So
is that a type of investment though?
Well, like
technically,
technically,
in a way, it's investing at 0%.
Let's
for
not
example,
say that because
or like,
because a lot of
no,
people
no, no, no,
we
no. The ones
literally
that give
just
out
said
percentages. The ones that give out
like a
TFSAs,
high interest savings
like
account.
like a high
or-
interest savings account or like an premium savings account. Technically, aren't those investments? Would you consider those investments?
In a
Yes.
way, because you are earning a return.
But it's not
right?
a good. It's not the best investment you can put it in, right?
No.
Yeah. So, how to 1 sec.
Well, you can keep like we'll keep talking.
How to actually define what a good investment is? Like a good investment, like I said, has a combination
We'll talk about that,
of
yeah.
those three things. So, bonds on average tend to be very secure, but they don't offer amazing cash flow.
So let's recap. Bond.
Yeah.
Sorry, not bonds. Security, cash
Cash flow and compounding. Exactly. So good investments tend to have the perfect combo of security, cash flow, and compounding. And the reason being is security, like if you actually take your eyes off of the investment and for a year you come back and it's still going to be there. Cash flow, month by month or like quarterly or semi-annually, does it actually put cash in your bank account, right? And lastly, compounding. If that 2.1 rate of inflation grows, and that's being compounded every year.
Yeah.
Are your investments also compounding at the same rate or higher? Right? Because if you have
So is it going like $100 to $102.10, and then it goes up to 100 and whatever? Like that $102 now goes up to 2.1%.
Exactly.
And now that whatever
it
like,
adds
2.1%,
on to itself, and it's why like Einstein said, I think that interest is the eighth wonder of the world. In that like compound
Einstein
interest.
said that?
Yeah.
Are you sure?
Are you
Yeah.
sure?
I think you said Jacob Mourinho is the eighth.
Nah. Yo. Einstein said that compound interest is the eighth wonder of the world. I believe.
Did he actually for real?
Did
say
he
that?
actually say that?
Yeah.
Einstein said that?
The man,
The physicist said that compound
Yeah.
interest is the eighth wonder of the world.
This
Yeah,
guy's smart,
fam.
man. He
Yeah.
knows finance. He knows physics. He knows everything.
Anyways,
knows it all.
but like, so let's talk about bonds, for example. Bonds might offer a lot of security in that, like, if they're government bonds, they're backed by the government. The Canadian government is not going away anytime soon, hopefully, right? but then when it comes to cash flow, bonds are a little bit more illiquid in that they typically only pay you semi-annual coupons, which are these cash payments that they might give you, and then the only other time you get paid is at maturity when the bond actually matures.
And on which those coupons, you yourself have to reinvest for the compounding effect to work, right?
Exactly. So you'd take your coupons and reinvest those coupons.
Or you can just take that. You can take the coupon as a cash flow and just use it.
Exactly. So that's bonds. Stocks, they can offer a lot of
But
cash.
what's the rate of return on a bond normally? It's normally very
It
low.
Depends on
isn't
the
it?
It depends on whether you're going with a government bond or a corporate bond.
and
Like,
also depends on countries, right?
Like Canada's, I've seen
Canada
kids,
and US is
I've
very
seen
low.
I've seen kids that have like a 10-year-old bond like come in. Oh, you made like $4.
yeah,
Oh no,
exactly.
they're
So
like in I would say in first world countries they're very very low.
yeah.
Second world countries and third world countries they get higher.
Yeah, in terms of the actual bond yield.
So if you're looking for like extreme safety,
you go to a first
then
world
I
country.
guess you'd go to a bond.
Yeah.
But if you're not looking for an extreme safety, like, but you actually want to make
also-
some money.
Yeah, but also like remember the safer it is, the lesser return.
Yes,
and
100%.
So forth, right?
Exactly. So those are bonds, and once again, a bond is you are buying the debt of a country. So as in you have money and you are lending your money out to the government, and the government is giving you a piece of paper that says I will owe you back this amount at a later time.
I forgot about another investment, but go on.
And then stocks, right? So stocks, they're very exciting. Everyone's always talking about like what's the new hottest stock, stuff like that, right?
Right now it's Tesla.
But anyways, stocks, essentially you are buying into the equity of a company, right? So, for example, if a company needs to raise money, they would issue out shares to the public, and then the public would buy those shares at an agreed share price. And then you hope that the company does well, it invests in itself. Like, if it's a tech company, it's innovating, it's making money, it's actually hustling, and then your stock is going to go up in price, right? So you're a shareholder in that company.
But there are also some companies that give out dividends, which is cash
Of course.
flow, right?
So I don't know if we're going to get into technical like that, but yes, you can get dividends from stocks. Stocks, they offer a lot of cash flow in that, like, you get
Dividends.
No,
through, like, if you invest like a lot of funds
In dividends.
and you're
but in
collecting
dividends, that's the
dividends,
thing.
yes.
So dividends quickly. So similar to like, I guess, like a savings account technically. Like so dividends. Some companies have percentages of how much they give back to their shareholders.
The dividend yield.
Or sometimes it's a specific amount.
It's usually like sometimes like leftover profit, and then they give
Yeah.
it back.
So basically normally they do them quarterly, or you can do them quarterly or annually or semi-annually,
Monthly
or
sometimes.
monthly. Some do monthly, depending on the percentage. The amount that you put in. So what a lot of rich people do, like really, really, really rich people, they'll put like like $2 million in a company that's super safe, but gives like 4 or 5% dividends, because that literally means that your money is safe, and you know it's safe, and it's probably going to go up eventually, but it's super safe, and they're giving you back like 5% of $2 million, so you can live on that.
So what is that?
I don't know, and I don't care to really do the math. But anyways, so that's dividend. So it's basically like the company being like, hey, you invested with it, like in us, so every month or semi-annually or whatever, we're gonna give you a percentage back on the money that you gave us.
Yeah. So essentially, yeah, stocks can offer cash flow. They can offer compounding as like they go up in price, right?
Yeah.
And you keep on reinvesting your dividends, and you can realize that. But in terms of security, I wouldn't say stocks are as secure as other investments.
Companies can
Right,
literally go
because
bankrupt,
companies
right?
can go bankrupt. Life happens, recessions happen, right, and they can go down.
Yeah.
Right.
Can I pause before we continue? You said rich people invest in these stocks that give 2 to 5% dividends. Can they just do the same with a bond that gives 2 to 5%?
No, but
And it's safer. And it's safer
but
too because the
like
government.
for example, like Coca-Cola.
No, yeah, I know.
Like
But
Coca-Cola, first of all, gives like good amount of dividends.
First
And
of all,
then-
let's not get hung up on the actual percentage that he said, because like the S&P 500 tends to
course.
average 8 to 10. So if you're investing in something that's
8
whatever,
to 10% return, not 8 to 10% yield. I mean, bond.
dividend yield, or
dividend yield. Yeah.
so you'd have to compare like the dividend yield versus the bond yield
Yeah.
on the coupons, and that depends on.
Oh, I was just making. Yeah, I was just
Okay.
clarifying that for.
Okay. Anyways, we're not trying to get that technical, guys. Okay. So we're trying to keep this high level, right? So in terms of yields, all that, now like let's keep this very high level. So from there, we talked about stocks, we talked about bonds. Now let's talk about, okay, what other investments are there? That
mutual funds.
Okay, mutual funds, right?
So mutual funds, by the way, you can get at a bank. Just so you know, the easiest way to get a mutual fund is just to do it at a bank.
To buy a mutual fund from the bank.
Yeah, like Scotia, RBC, like TD, anything. Just go to a bank and just be like, hey, I want to open up a mutual fund.
Yeah, exactly. And like typically a mutual fund, it's in terms of risk, it's a little bit safer than a stock, because you're now investing in a pool of stocks, so you're diversified. And in diversifying, it's like not putting all your eggs into one basket. You're putting your eggs in multiple baskets, so that even if you do lose a basket, you still have 9 or 10 other baskets that are still earning you money, right? So a mutual fund is a little bit safer than a stock. So in terms of returns, right, they tend to offer a little bit lower returns. Cash flow wise, I wouldn't say mutual funds offer a lot of cash flow unless you find a mutual fund that is giving out dividends like a stock, right? Other than that, they're pretty locked in. So security, they're decent on security.
And plus
Compounding different, but cash flow, they're not good for cash flow.
And plus mutual funds, you can do like, there's a lot of different types of mutual funds. Like you can adjust the risk that you want. There's low risk, there's mid risk, there's high risk, and obviously again, like Jacob brought up,
depending on the
risk
portfolio.
like Jacob said, like the risk that you put up is the return that you get. Obviously, the high risk is what's going to get you the biggest.
Higher
return.
risk always means higher reward. So, and this is typically reflected by the return. If, for example, if you know this wild idea, might make you $10 million and you only need to put $50 into it, then man, it must be really risky as hell, because it's like. Because you have such a return coming to you, what is the risk out there, right?
Dude, that's a fucking great investment.
Exactly.
That's not risky at all. You
No,
only lose
no.
$50 in
But
that
then-
worst case scenario.
No, yeah, okay, true. Maybe.
That was a bad example.
Bad example. Let's step back. What's an example of something that
You don't need to give an example. You don't need to
Bitcoin.
give,
Oh my god,
Bitcoin.
Bitcoin. Bitcoin is like a perfect example of like a really high risk and really high return, right? If you got into Bitcoin early, for example, and like invested your money into Bitcoin and rode the whole Bitcoin rush, yeah, you'd probably be a multimillionaire by now.
And if you didn't forget your password.
But also, if you got into Bitcoin maybe like I would say a year or two ago when we had that flash crash in Bitcoin, you would have thrown a lot of your money in, and then bam, it's gone, right? Because the value of Bitcoin does not come from the actual intrinsic value of the asset itself. It's based off the value that we all assign to it.
That's actually that's what a lot.
And
of
that's
people
the
do
issue with
stocks.
Bitcoin, right? So the volatility or the riskiness of it is much higher because it's not really backed by anything.
But that's with everything,
Right.
Like,
It's
like,
not even it's not only like even
For-
like
for
example
like
Tesla stock. If
Yeah.
you invested last or 2 weeks ago, when it was like at 800, because you're like, oh, this is getting big, and then it
But
dropped down to
ideally-
700 a year.
So ideally, the share price tends to reflect what all the investors or what all market participants agree what that price is. Hence the theory of like efficient markets. We're getting a little bit technical, essentially, right? But you can actually trace that dollar, like that 800 bucks, into some sort of either machine or a part of a car, and actually be able to attribute some value in that tangible value.
Okay.
But
Into the company, like the actual-
into the actual company,
Like
into
Nike-
Tesla,
like Nike
right?
can be like, oh, there's a shoelace, like-
there is a string that I maybe own half a string of, for example.
Okay,
if you
yeah.
really had to
I
like
see what you're
trace it
saying.
down,
Yeah.
but on Bitcoin, what are you going to trace down?
Well, that's the thing.
What are you gonna trace
I
down?
feel like we should
Mind
move on,
blown, mind
but Bitcoin is one of those things that, like, unfortunately, people invested in it when they didn't really know what it was. They didn't really understand it, and they just did it anyways because it was
there's
a
the
wave.
potential. There's the potentiality to earn a very high return,
There's also
but you're
potential
also
to lose a
taking
lot
a
of your money.
very high risk. Hence, there tends to be this correlation between risk and reward. That the higher the risk, typically the higher the reward. Right?
And that can be found in all industries.
Yeah, exactly.
So
So
let's talk about one that has all three, the golden
all
nugget.
three,
What is it, bro?
the golden nugget.
You know what I'm gonna start doing
Okay.
before we
This
do
guy
it?
doesn't care what it is.
No. You know what I'm gonna start doing before every like podcast? I just realized, like.
Are we gonna cut this out?
No, we're not gonna cut this out. There's no need to cut this out. We'll do we should do before we actually record it, like a day or two before that, we'll put out a poll relating to.
Oh yeah.
Podcast.
Kind of like what Jacob's been doing. Yeah.
Yeah,
Yeah.
Okay.
but like you know what I mean. But
I know what you mean.
like
Like, what are your thoughts on whatever investment?
not
yeah.
because you used to do like polls.
Yeah, that's what you just said, no?
No, not polls. Like being like a question, being like
On that poll.
What do you know about investing?
Oh. You know,
What do you know about this? You know
I
what
don't think
mean?
my account is the most effective because no one fucking even watches my videos. Go watch my videos.
Ah, guys, that's
Okay, anyways,
sad.
move
Watch
on.
Jacob's videos. He puts in a lot of effort into his videos, guys. Watch it.
Anyway, bro, what is this golden nugget that gives
Okay.
us cash flow, compounding?
And security.
Yeah.
Man, yeah, because so far we've seen that there's investments that offer a lot of security, but maybe not so good on cash flow compounding or vice versa. So who's actually going to say it? Who's going to say
I think
it?
I think mutual fund is the best investment that isn't like if you're looking for
You're joking, right?
no.
Yeah.
Listen,
You better be joking.
No. To like again, obviously real estate's we'll bring it up like real estate's that one, but I mean like in terms of a person who doesn't want to necessarily worry too much, but also wants to get a decent return. I think I think mutual fund is what you should be looking at.
Nah,
I
I disagree,
think
and
that-
I think this will like show how it all depends on the type of investor you are. But mutual funds have something called management expense ratios,
Of course, yes.
right?
Yeah.
MER fees. So as in, and the thing is, what people don't tell you is that those MER fees they compound over time. So as in, if you have a $50,000 investment, and let's say it grows to maybe $500,000 over like the span of 40 years, for example, right? Even though you might have earned like maybe like 500K,
You
the
could have-
actual MER,
you
the
would've-
management expense that would have compounded over time will probably be $100,000 or $200,000. So that's
Yeah.
like $200,000 you've given to a bank or someone else to just have.
But you made $500,000 though.
Yeah, but you've also given away $200,000 or like $100,000. So it's like you are basically being charged to have someone else who's smarter than you, hopefully, to manage your money for
Yeah.
you. That is why there's
That's
like
super
fees.
normal.
with-
But
Yeah,
to be fair,
but everyone
to be
does
fair,
that.
you
Like,
wouldn't
nah.
have earned that money without that smart person.
You pay, when you pay for a web developer. It's the same thing. You pay someone.
No,
you-
it's
you
not.
pay-
It's not necessarily the same thing because also
or like,
like
a social media manager.
also it's
A social media
It's also
manager.
like, for example, when you find that these mutual funds earn the same returns that the stock market does, anyways, you could have invested it in an index fund,
but
for
you-
cheaper. And,
but-
and it's why ETFs, exchange traded funds, have taken a larger popularity than mutual funds. Mutual funds back in our parents' day, mutual funds were the thing because banks came out with it like it was a very exciting product.
Good point,
Right,
good point.
but we've now transition into this age of exchange traded funds where you could just buy these yourself and save yourself a little bit more money and be a little bit more independent.
That's a good point. I might
So
buy
like
an
Quest Trade or like self-directed
Really?
portfolios. Yeah, right. So like
money sitting doing nothing. I don't want to know what to do.
exactly. Or so exchange traded funds offer you a little bit more security, but more control
Okay,
as well.
so the last one.
So what we're talking about this three things: security, cash flow, and compounding is education.
Oh,
Was that what you guys were thinking?
that is a good point, but
Wow.
I was gonna say real estate, but that
Wow.
actually
Yeah, real estate as well,
But no. Actually, let's touch on that before we even get into real estate. I think you brought up. I've never thought of that. If you think about it, education also fits in that category because it offers you security in that you will always know, and you will like once you learn something that is with
sticks
you
with you.
until you
what
die.
type of education are we
Sticks
talking
with you.
about though?
Like let's say you decide to go whatever.
No,
like
engineering sucks.
education can be obtained both institutionally or it can obtain like from experience.
So
You know.
so it's knowledge in yourself, like education in general. Yeah,
exactly.
Okay, so we're not talking
Right?
about like school education.
No,
specifically.
yeah. You can get education from other sources outside of
agree.
school, as we've both experienced that.
I agree.
So I think, number one, security. Education means that you will always keep that with you, right? In terms of cash flow, once you
What
actually
if you have
apply,
Alzheimer's?
oh, damn.
Anyways, go on. I'm joking.
What if you
Shout
have
out to people with
Alzheimer's,
Alzheimer's.
bro? Why?
I'm joking, man. Just go on, man. Sorry, I apologize. For hurting you.
Education can also bring you cash flow if you use it in the right way. Did you say that?
Yeah. No, yeah. No, I'm just thinking about Basil's comment. He lost me there. Anyways,
My bad. Go on. Anyways, go on.
so cash flow. If you actually apply the education that you learn right in that direct field, it will give you a return because you will get paid for that. For example, if you decide to go for an engineering degree and then eventually get an engineering job, you are earning cash flow from that. And you will continue to be an engineer all your life because you have that knowledge
Yeah,
with you.
technically, yeah.
Compounding, like as you get older and your experience grows
build-
in
build
that
the knowledge
field,
on top
you
of
can
it.
charge more, right? People become worth more. It's why CEOs earn like $2 million, especially if they've worked their way up the ranks. For example, they earn very high salaries.
Because their experience is built on what they know and this continues.
Exactly, right? So education, wow, thank you for that. I've never really
And then the other boring one is real
So
estate.
the other one, the other really like whatever one is like real estate.
houses. Let's talk about it.
Real estate, in my opinion, is probably the best investment you can make. And there's two different ways I would say you can make that investment. One, obviously, you doing it yourself, and then one is like it's similar to all these. Again, like you talked about the mutual fund thing, paying someone to do it.
Yeah, a real
Same
estate
thing.
investment trust
You can-
kind of thing.
No. I was talking about like JVing with someone.
Oh, joint venture.
So
okay.
joint venturing, like either like I think there's two ways of doing it. Is one, you doing it yourself, becoming your own landlord, all that stuff, and then number two, literally, if you don't want to do any of that, give someone the money, and then they'll do that for you.
What Basil is saying, if you don't want to do that, joint venture with Capstone, contact us.
But no, actually, so why? Okay, why is real estate
So
probably the best investment you can make?
real estate offers security because, for example, it is a physical asset. So you can actually, like, for example, once you invest in a property, whether that's commercial, whether that's through our investment trust, you can trace your money to a physical property that's at a physical location, and you can actually go see it. Right. So in some way, it's like securing that it's there physically, but also it's real estate is secure because the banks also invest in real estate. Every time a bank gives you a mortgage, that is them taking an equity position in your home, as in that is them kind of investing with you and being like, hey, you give us a down payment, we will actually cover this amount, and we will own this property together. Because the bank also knows that the home will go up when you sell it. You clear them off; they always get paid their mortgage plus the interest. Right, so the banks are also happy in knowing that it's secure, right?
Is that the banks really investing in real estate, or
in a way, yeah.
Is it the banks just really just loaning you money?
Because that is essentially
Because
what
think
private
about it.
lending is. Like private lending
know.
is you become a bank.
I know, but you just said
Right?
after the money. After you buy the house, it appreciates whatever you decide to sell. So you say,
I think technically Jacob's right. Like it's just the bank is lending you money.
because if the bank
And-
was really smart, they
Oh,
would
no,
invest
but-
in the
but
real
I mean,
estate itself. That earns
no,
you more.
like banks
No, but
invest in real estate.
Banks don't care to find houses to invest in.
That's what I'm saying. So it's not really.
No, that's why part of
investing.
part of being approved for mortgage is not just your income
yeah,
yourself;
it's
it's
also
the
the house
property.
itself, by the way. Yeah, I was literally
because
gonna
a
say
bank would not
You
would not
can't
look
say
at
that.
it.
Like, you can't just
Exactly.
say, hey, I'm going to get a mortgage, and then you don't actually show them a house.
That is
Exactly.
true.
So
So,
that is
yeah,
why like
he's
banks
right.
also
That's a good
invest in
point.
real estate, and I think that's something people don't understand. Banks invest in real estate. That is just a
Western
fact,
invest in real estate.
right? Universities, wait,
Oh,
like
Western. Oh,
Western,
Western.
yeah, like
Western has
universities
crazy
invest
real
in real estate. Like these huge
talking about, like, real-
institutions,
like-
right?
No, like,
Houses?
well, all, like, student housing,
Yeah.
all those are, there's, do you know how much, do you know how much
Isn't student housing owned by actual landlords?
No, it's all
I mean,
owned
not
by
landlords.
Western.
It's some actual
No,
like
it's owned by
independent.
Western. Like all those red bricks, like
Seriously?
like
Red
beside
bricks?
Elbourne
Yeah,
College,
yeah,
and-
exactly.
and
So-
all
so,
those
yeah,
those
yeah,
are all
yeah,
houses
the-
that are owned by.
Oh, I
what's it
didn't know
called?
that. I didn't know
Exactly. So McDonald's is a real estate investment company because McDonald's does not really so as much as they have a really efficient process, right? McDonald's is actually a real estate company because they invest in the physical location first. The first thing
So
yeah.
moral of the story, basically, it's safe. It's safe
Exactly,
because
so
number
security.
one, there's something you can actually
Yeah,
like,
that's good.
like number one, you know that the top companies, like the banks, the billionaires are doing it. Number two. Obviously, no. That doesn't justify it because
Yeah.
one,
Yeah.
that's
Just 'cause
no,
they're
no,
doing
just
it,
'cause-
I'll do it.
No, that's actually not a
Because
good.
that means
that's not a good reason.
stocks will be safe. Warren
Yeah,
Buffett does it.
that's not a good reason. Actually, ignore that. The main good reason is because first of all, it's actually backed up by an asset. You physically see what the actual thing is, like you know it's there and it's not going anywhere. And if you bought it for 200,000, it's gonna stay worth 200,000.
Not necessarily.
Obviously,
I
except
mean,
for-
it could go up and
It
down.
could go up and down, but I mean,
Yeah.
like, but even as long as you don't sell it, it doesn't matter because you know that the recession's only gonna happen once a year. Or once every 10 years or whatever. Like
Damn.
whatever.
if a recession was happening, once
Every 10 years. So
But yes.
so even if it goes down,
Yeah.
you know that houses are gonna go back up.
Exactly. So and then a real estate offers cash flow in that, for example, if you have an investment or a rental property, you can collect rents month by month. So that's actual month to month cash flow. So the beautiful thing about real estate is the frequency of the cash flows is a lot more frequent than other investments in that
It's
you actually
monthly.
get it monthly instead of
Yeah.
like semi-annually or like annually, or quarterly, right?
And the last one is compounding.
Compounding. So as in real estate is also inflation protected because the banks are investing into it and they get their money also from the Bank of Canada.
Bills appreciate.
Exactly. But anyways, so real estate tends to appreciate, anywhere from like 2.1% to 5% a year minimum.
Unless
Just
you're living in London, it appreciates
10,
like
15%. Yeah, exactly.
Or Toronto, 8% in
Oh,
the past 3 months.
900%.
Yeah, right. So real estate offers you that compounding in that every year home prices tend to go up on average, right? Until we have a market correction and then eventually goes down and then it comes back up again. So that's what Basil was talking about, like the real estate cycle, and that around like 10 years or so, 10 to 15 years, we tend to have a market reset.
And it's
right?
a correction mostly, I guess.
yeah,
Mostly it's a
exactly.
correction.
In almost all financial sectors,
Yeah.
whether it
Yeah.
be
And
real
it's something,
estate,
something that our coach
blah, blah,
even
blah.
said, like, apparently, the average house went down, even in 2008, apparently it went down 8%.
Mm-hmm.
And if you think about it, like,
Yeah.
what we do, for example, like how cheap we get our houses, like, we're getting them for less than 8%, like less than that.
Yeah, in terms of
Anyways.
the discount.
Yeah, so it's like even when there's a recession and a market correction, it's not like the houses go from $300,000 to $3,000. It's not how it works.
Oh, really?
So I don't know. Like it's
Yeah, so ideally, like I think what we're trying to say is that based off of our opinion, right? Once again, this is all our opinion. Real estate for us is one of those investments that offers the
let's
perfect
rank
combo.
them. Let's rank them.
Sure.
I guess quickly. So
So
I
in
think
terms of
we'll-
like liquidity, I would say because real estate is also very liquid. Like you're,
very.
real estate isn't liquid.
He said e-liquid.
illiquid.
Oh, illiquid.
Yeah,
Okay.
yeah,
I
exactly.
thought you said very liquid.
As in your money is going to be tied up in
Yes.
in an actual property until you get it out. Right.
Yes.
So in terms of liquidity, real estate also does not offer as much liquidity.
Nope.
But it balances itself off with the amount of cash flow you get out because hopefully the cash flow can balance that illiquidity.
Yeah, that's actually a good point. I know a lot of rich people who are not very rich. They own so many houses, but they have no money. Like you
Yeah.
can literally ask them, "Yo, can we go out to eat?" It's like I have no money,
Yeah.
but they
because
own.
they're cash tied.
Yeah,
Yeah.
Which makes sense. It's
Exactly. And like I have met investors who are like cash tied in that, like they're over invested and they don't actually have, liquid cash. And that's like the other thing about investing is you also
have to
want to make
balance it.
sure you want to balance your liquidity, right? As much as like huge institutions look at things called current ratios to make sure they're liquid enough to like meet their day-to-day cash needs, you also need to make sure that whenever you're investing, take care of yourself first. Always, right? You never want to like jump into investment when you're not in a stable position, because that will only make you more unstable. Wow.
I just thought of a topic. Okay, never mind. Continue.
What? Anyways,
Wow.
I'll tell you guys after.
My words do
Anyways,
that to people.
So
Yeah.
okay, so yeah, we didn't. So did we end up ranking them? Did you rank them? Okay, you rank them for yourself personally.
Okay,
And then
so-
so do top three, and then we'll
So
do top three.
my favorite investment, number one right now, is real estate, I would say. Number two would have to be myself.
So how do you compound? How your security and how do you cash flow?
Exactly. So right now I'm secure because I invest in my own knowledge, whether that's finance knowledge, business knowledge, whatever. So that's my security there. I cash flow because that I go and work at a bank, and so my degree is in financial modeling and stats. So it's still relevant. So I'm actually applying my degree even as we speak, and I haven't graduated yet, right? And then in terms of my compounding, well, hey, that is exponential. I think my return's going to be over 1,000,000%. Ooh.
Why'd you say it like that? Anyway,
Okay, and the third one.
All right, third one. So outside of myself, then I would maybe go into ETFs, exchange traded funds would be next. From there, from there I would go into what do you call it?
I mean, how many are we doing top what?
just three.
Okay.
Yeah, no,
you've done
but-
top three.
Oh, top three. Okay, yeah, bet that's
Okay,
that's
so
that.
number one for me is education. So you got to know what you're doing before you enter any
So that's
investment.
like yourself.
Yes,
Because
I guess
Yeah.
it's the education,
So he put himself first.
of course.
Always
Second
do
one,
that, ladies and
second
gents.
one. Let me be less philosophical with what I'm saying. Real estate, and third one, government bonds, just for safety. Real
Yeah,
estate, more cash flow.
Jacob's a very safe guy, by the way. Because also the other thing we haven't talked about is risk appetite. Like
That's
you have
true.
guys who like, okay, I'm fine with taking major risks because like they're young and they'll know they'll make it back by hustling. But you also have guys like Jacob, the frugal investor, who's like, no, I don't want to take risk.
But you also hold on. It's also good to diversify your
He's
risk.
scared.
It's good to diversify your risk. If you hold some,
He's scared.
if you hold some bonds,
Yeah.
if you hold some real estate, if you hold some stocks that are very volatile, it's very diversified. You have some very safe ones. You have some very volatile ones going to lose you money quick.
Yeah.
But overall,
So would you rank yourself as the volatile one? Because right now, I mean, like
Me?
bonds, yeah.
I would rank myself as a cheap one.
Okay. All right.
Mine I'd say is similar to Stefan probably, but mine would be like mine is real estate, and then ETFs, and then education. I think
Oh, really?
Wow.
because education, man, like I don't know. I realized through school, like
No, not school.
I know,
Yeah,
but I mean,
like,
like
go buy a course.
So far, my experience with education has been horrible.
So far, yes, I can kind of
Because
agree.
I-
Like if
because
you're talking
my-
about institutional education as well,
Yeah, like, so
I
far
mean, yeah.
my
But then
investment for
also,
engineering is
I,
shit.
I look at Western, like
But your education in real
Western
estate-
did not only offer me, for example, like
Yeah, but I mean, like I spent a lot more on engineering.
No, but what I'm saying is your education in real estate.
Yeah, but yeah.
That's education, right?
I know, but I mean, like as of
terms
right
of
now, I
yeah.
do real estate, ETFs, and myself.
Okay. All right, guys. Well, I think that's kind of it for this episode. Let's do some quick takeaways.
What takeaways? There are no takeaways for this.
Yeah, like in terms of what's your biggest thing that you've learned?
My
in this-
biggest takeaway is like before you invest in anything, just learn a lot about it because it's a lot easier said than done to
That's
just
actually
invest
true.
in anything.
That's true.
I think my biggest takeaway is just before you jump into ETFs, stocks, mutual funds, real estate, anything you jump into,
Learn.
Make sure you're at least learning a little bit. Like even if it's basic stuff, just don't do anything that'll jeopardize yourself because even if you're young and have time to recover, there's no need to put yourself in a situation like that. That's basically my one takeaway.
Jacob.
My takeaway will actually piggyback off that. Before you invest, hit the like button, subscribe,
Facts.
share, and
Facts.
also, I like what you said. How you said about the time to recover thing. Warren Buffett is an investor I look up to, and he was overall a safe investor, and he took advantage of the time he has. He wasn't a person who wasn't trying to get rich quick and whatever. He took advantage of compounding.
That's a good one.
He took advantage of his dividend stocks, which is cash flow, and he also took advantage of what else? Security, which is the businesses he owns. So, yeah. So be patient with it, and and
do it for the long run. Not
do
if,
it
if
for the
you're
long run.
planning on
Yeah,
investing, do it for the long run,
Yeah.
not for like a
Exactly.
quick cash.
Yeah. Wow, I think you guys have taken all my takeaways, but I'm gonna try to go off.
We took
Yeah.
away your takeaways. Ooh, bars.
I already can think
How you
of one.
gonna, how you
As soon
gonna
as
take
go,
away
think
my
of one.
takeaway? I think my biggest thing is the setup. I think how you set yourself up is crucial. For people who are looking to jump into real estate, kind of like what we've done. How you set yourself up in terms of preparation, whether that's knowledge, whether that's business systems, whether that's employees, whether that's branding, however you decide to take it. How you set yourself up matters because it sets the tone for everything else you're going to do. And I think that goes into any investment. So if you're gonna decide that you want to fall in love with stocks, or maybe that's your risk appetite, set yourself up properly. Actually learn as much as you can, right? Figure out, what's the cheapest way to get into stocks, like brokerage accounts, right? Figure out, margin accounts, what's available, right? And then from there, actually figure out, do you want to do it alone? Do you want to raise capital? There's a lot of structures. So the setup matters because how you set yourself up also determines what your cap is going to be. Regular individual investors do not have the same setup as a hedge fund manager or an actual investing company, right? So figure out how you want to set yourself up and go about it that way.
All right.
Okay, so anyways, subscribe, comment, let us know what you think. People aren't leaving comments on the episode, which is kind of sad.
Why,
but
guys?
Whatever, it's all good.
Honestly, let's ask them to leave a comment.
We do that. I think
let's
we do
ask
that.
them. Let's tell them. Tell us
What's your number one? What's your number one strategy of investing?
No. Tell us what you think you've invested in so far.
What?
Yeah.
Like,
for those of you who've invested, tell us what you've invested in, and if so, good, bad.
And if you haven't, are you gonna start?
Exactly.
So anyways, comment, subscribe, and we will be. I think we're fixing everything now. I think we're good. We're posting every week now, so I think we're fine. So
hopefully. Inshallah.
Anyways, so we'll catch you in the next episode. And yeah, thank you for viewing, and take care.
Peace.